Okay, hey everybody, Scott here again with a brand new video, and for this one here, I'll be answering the question of should you be using stop losses with option trades that have defined risk. So for example, that includes things like credit spreads or iron condors, debit spreads, things like that. And just to give you the short answer here first, in my opinion, you should not be using stop losses with these kinds of trades. But that being said, there is also one exception, as you'll see later in this video. One situation basically where I do think that perhaps using stop losses is actually acceptable. Now, as always though, before we dive in here, make sure you guys watch until the end of the video, because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to 2,500 bucks. And also here, for anybody who would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So definitely make sure to check out the description of this video below to learn a lot more about that. And then finally here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join Skillshare using any of those links, you'll get a full 1 month free trial. Alright guys, so now diving in here, and for my main example that I'll be using in this video here, we'll take a look at SPY, which is an ETF that tracks the S&P 500. And then also, for the sake of example, let's say that I'm perhaps a new trader and I have about $10,000 of capital to start trading with. And so with that in mind, if we take a closer look here at SPY, I'll zoom in a little bit. And just by taking a look at this chart here, perhaps my assumption for a new trade is that SPY here has gone too high too quickly, and perhaps at this point we're seeing the beginning of a new downturn in this more general uptrend here. So ultimately, with that in mind, maybe at this point I want to sell a call credit spread above the current price of SPY and play for a downside move. And so now at this point, given that I have my assumption on this new trade, we'll come over to the trade tab here and take a look at the option chain for SPY. And for the sake of example, we'll go into the August 19th monthly expiration with 17 days left to go. We'll unfold that tab here and scroll down a little bit. And so again here, like I showed you on the charts for this new trade, maybe I want to sell a simple call credit spread. And typically the way I sell credit spreads is for the short strike, I will choose around the 30 delta. So for SPY, that comes in right around the 419 strike call option. And then for the long contract, that depends of course on how much risk I want to take on this position. And so now it's at this point where my argument about why you should not be using stop losses with defined risk trades comes into play. Right? Because what if, for example, I initially wanted to make my spread here $10 wide. So again, that means my short strike is at 419 and my long strike is 10 bucks away at 429. And so real quick here, let me go ahead and create that order. And here we go. This is the order to sell that $10 wide call credit spread. And I'll try and lock in a price of exactly 230 bucks as my starting credit. And so of course, now this means if my credit is 230, the max loss on this spread is simply the width of the spread minus this starting credit. So 10 bucks minus $2.30 on a per share basis here is $7.70. So therefore, multiplying that by 100, the max loss on the spread is 770. And also, for example, if I do go to confirm and send, you can see that right here with the buying power effect, 771 bucks or so. Not sure why it's 771. But this here is the maximum possible loss you can take on this exact position. And so at this point, before you do send the order, this begs the question, of course, is this maximum loss acceptable to you based on your risk tolerance and your overall account size? So again, as I explained, for the sake of example, my account here is 10,000 bucks. I'm a new trader. And so risking up to 770 bucks on this one trade, that's about 7.7% of my entire account. And generally speaking, my rule of thumb is to not risk more than 5% of my account on any one trade. So that's why in this case here, this would be too much risk for me with this one position. And so therefore, instead of using a stop loss on this trade here to limit my exposure to under 770 bucks, what I can do is actually just decrease the width of the spread. Right? Because ultimately, if you do use stop losses on these kinds of trades, which already have built-in limited risk anyways, then you are going to severely limit your profitability on these positions in the long term. right? Because let's say, for example, maybe halfway through this trade, SPY has a massive rally and blows through both of your call strikes here. And so at least for the time, you are going to have a loss, at least on paper, for this trade. But if at that point your stop loss got triggered and you were taken out of the trade, well, you are going to book that loss and still leave a lot of time left on the table for the trade to come back around. And bottom line here, like I explained, because these trades do have built-in limited risk, I mean, basically the long option is your stop loss with these kinds of trades. Then if at some point you do find yourself in a losing position, well, at that point, you have little more left to lose, but everything to potentially gain back. And so that's why, in my opinion here, with these kinds of strategies, you should be comfortable when you first place the trade with that maximum loss possibility, right? You have to risk something to potentially have some reward when trading in financial markets. So again, with this trade here, if the max loss is simply too much risk for me or too much risk for my account, then fine, I'll just change the width of the spread to reduce that max loss. So perhaps now, instead of this spread being 10 bucks wide, maybe I'll make the long option only 5 bucks away. So that would be the 424 strike call option. Now, of course, also, I will collect a lot less in credit on this position because I'm taking less risk here, but that's exactly the point, right? So for example, if I try and lock in a price of $1.50 on a per share basis, and then go to confirm and send, now you can see the max loss or the buying power effect is only 350 bucks. And actually, now that I think of it here, the reason why the buying power effect is actually $351.30 is because I do have to pay $1.30 here in commissions. But still, now at this point, again, if my account is 10,000 bucks, then this trade here is only risking about 3.5% of my account, which is much more in line with where I like to be. And now at this point, I can be in this trade all the way until the expiration date if need be, to potentially wait for this trade to come around and be profitable. Right, so now I never have to worry about stopping myself out if the losses on this trade get too big, because now with this particular setup, the losses will never get too big. And therefore, as I said, I can be in this trade for as long as I need to potentially make a profit. Now, that being said, though, the one major exception to that rule, in my opinion, is if you do intentionally want to trade very wide spreads and therefore take on a lot of risk because you want those positions to behave just like naked option trades. Right, so for example, in the case of a call credit spread here, if you make this spread very wide, then it's going to behave more and more like a simple naked short call option. And that's because, of course, the wider you make your spreads, the more exposure you'll have to the option Greeks, specifically delta, theta, and vega, also gamma as well, but these are the three most important ones. Right, so for example here, instead of selling this call credit spread, if I just sold this 419 strike short call option, which would be a naked call option, then I would have full exposure to delta, theta, and vega. However, in the case of a spread strategy, in this case here, if I also purchased the 424 strike call option, then the delta, theta, and vega on this contract is going to offset almost entirely the delta, theta, and vega on the 419 strike call option. Right, so you can see here the delta on this contract is 31, but the delta on the 424 strike call option is 21. And therefore the difference here is only 10. And bottom line, that would be my exposure to delta on this spread-based trade. Only 10 as compared to a full 31 with a simple naked call option. And then of course, the exact same concept applies to theta and vega as well. But now, for example, if I instead purchase the 439 strike call option way down here, and therefore this spread is now 20 bucks wide, well, as you can see way down here with the 439 strike call option, the delta, theta, and vega values are all almost zero. And so as a result, this spread here is going to behave a lot more like a simple naked short call option that has a 419 strike. Right, so this trade here and just selling the 419 strike call option by itself, they're both going to behave very similar to each other. And of course, also with this new position, I'm going to collect a lot more in beginning credit. Now it's over 300 bucks in starting credit, but of course also I'm taking on a lot more risk as well. Right? So for this spread, the max loss is almost 1,700 bucks, which obviously for a $10,000 account is way too much risk. But again here, if you intentionally want to trade these very wide spreads because you also want these positions to behave a lot like short naked contracts, perhaps because you don't have permissions to sell naked options in your account, then in that case, I think using stop losses is totally acceptable. right? So for example, with this particular call credit spread here, as I showed you, the max loss is almost $1,700. So of course, if that's too much risk for your account size or just for your risk tolerance, then you definitely can stop yourself out well before you reach that point. But also here, one last thing to mention is do keep in mind that there are different ways of managing and defending your trades besides just cutting your losses. And in particular for selling options, you can always roll your contracts out to the next expiration cycle, or perhaps sell other options against your existing position to ultimately collect more and more credit and reduce your risk at the same time. So bottom line here is, before you do decide to use stop losses on these kinds of trades, at least just pursue different kinds of management approaches to figure out which one might be best for you. And so with that being said here, that's going to do it for this video. I hope you enjoyed it. But of course, one last thing, as I mentioned, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they are offering you the opportunity to receive up to 10 free stocks when you open a brokerage account using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.